Hi, this is Money and Investing. If you like this kind of content, please consider hitting the like button and subscribing. It will really help out my new channel and give me inspiration to create more content like this. Thank you. Earnings per share, or EPS, is calculated as a company's profit or net income divided by the outstanding shares of its common stock. The resulting number serves as an indicator of a company's profitability. It is common for a company to report EPS that is adjusted for extraordinary items and potential share dilution. We will get into this later in the video. The higher a company's EPS, the more profitable it is considered. For now, EPS is just net income divided by the outstanding shares of the company. Or if the company pays a dividend, EPS equals net income minus preferred dividends divided by outstanding shares. EPS indicates how much money a company makes for each share of its stock. The earnings per share metric is one of the most important variables in determining a share's price. It is also a major component used to calculate the price-to-earnings valuation ratio, where the E in PE refers to the EPS. We will get more into this in a later video. Comparing EPS in absolute terms may not have much meaning to investors, because ordinary shareholders do not have direct access to the earnings. Instead, investors will compare EPS with the share price of the stock to determine the value of earnings and how investors feel about future growth. Basic EPS versus diluted EPS. The formulas used previously are called basic EPS. Basic EPS does not factor in the dilutive effect of shares that could be issued by the company. When the capital structure of a company includes items such as stock options, warrants, restricted stock units, or RSU, these investments, if exercised, could increase the total number of shares outstanding in the market. For example, the total number of shares that could be created and issued from NVIDIA's convertible instruments for the fiscal year was 33 million. If this number is added to its total shares outstanding, its diluted weighted average shares outstanding will be more and therefore decrease EPS. Dilution just means that a person owns a smaller percentage of the company as more stock was issued, and therefore owns a smaller percentage of all shares outstanding. EPS excluding extraordinary items. Earnings per share can be distorted, both intentionally and unintentionally. Analysts use variations for the basic EPS formula to avoid the most common ways that EPS may be inflated. Imagine a company that owns two factories that make cell phone screens. The land on which one of the factories sits has become very valuable, as new developments have surrounded it for the last few years. The company's management team decides to sell the factory and build another one on less valuable land. This transaction creates a lot of profit for the firm. While this land sale has created real profits for the company and shareholders, it is considered an extraordinary item because there is no reason to believe the company can repeat that transaction in the future. Think of it as an outlier. Shareholders be misled if the windfall is included in the numerator of the EPS equation, so it is excluded. A similar argument could be made if a company had unusual loss, which would have temporarily decreased EPS and be excluded for the same reason. The calculation for EPS excluding extraordinary items is EPS equals, on the numerator, net income minus preferred dividends plus or minus extraordinary items, all divided by shares outstanding. EPS in capital. An important aspect of EPS that is often ignored is the capital that is required to generate the earnings, net income in the calculation. Two companies could generate the same EPS, but one could do so with fewer net assets. That company would be more efficient at using its capital to generate income, and, all other things being equal, would be a better company in terms of efficiency. A very important metric that can be used to identify companies that are more efficient is the return on equity, or ROE. We'll get into this in a later video. This is Money and Investing. Thank you guys so much for watching my video. Let me know your comments and what you think below. To those who are still watching, you're amazing. If you like this content and would like more videos, please consider supporting me at my Patreon page linked below so I can get better content out there for everyone. Thank you all.